What is a liquidity crisis?
Simply put, there's no buyers. Josh, here's what this would look like in the equities market. Think margin call. Imagine the montage when the firm is selling off the mortgage-backed securities. It starts in the morning and Kevin Spacey's character comes out and says, listen, you've got to come out of the gate swinging. You've got to move this stuff. It has to be completely off your books because by lunchtime or whatever, right, you'll be taking, 60 cents on the dollar for whatever these assets are worth or whatever, right? Essentially what's going on in this particular situation is margin call. They had to move an incredible amount of what they assumed to be assets off their books, even though those assets were a steaming pile of garbage. But the catch is that there's only so many buyers in the market. And when you start depleting buyers, you can still find buyers, but you have to basically be willing to sell for less and less and less and less. And if you deplete all of those and you basically run out of buyers, you go into what's called a no bid situation, or essentially you might have an asset, even the asset's worth something that nobody is just willing to pay for, or they just don't have the funds to pay for it. So when people talk about the liquidity crisis in the market, the implication there is that if, let's say, you have a stock, if you have a mutual fund, if you have a bond, particularly with the debt market, that you can't flip into cash because there's not enough buyers to give you cash for whatever that asset is, that's a problem. Because in order to find buyers, you're either going to have to discount to a price, and if you discount it to zero and there's still, or 1 cent or whatever, there's still no buyers there, that's a huge problem. And it's going to drag down, it has potential to drag down the rest of the market with it. Rickards talks about this with this ICE 9 scenario. And his thesis is that what you'd see is you see regulators step into freeze transactions. In book number 3, I can't remember which one it was, he talks about how the government was trying to interfere with BlackRock. Now, BlackRock, for those of you who don't know, is an asset manager. BlackRock isn't an investment company. Rather, they help people manage their investments. But nonetheless, the fact that the government wanted to be able to freeze BlackRock, and by freezing BlackRock, essentially freeze the investments BlackRock controlled and managed, that would seem to suggest that the choke point that they're going to try to go to if they do want to freeze the market to prevent a complete sell-off and a collapse of the system is to stop people from buying or selling. So what does this mean to you in real life, Josh? Well, you'd probably be able to log onto your portfolio, your Webull, Fidelity, or whatever, right? You'd probably be able to see all your positions. You just wouldn't be able to trade them. It'd almost be like being in an extended Bizarro holiday type thing. So it'll be frozen. You'll see it. You won't be able to touch it. And that's just with the equities market. This is where the real problem arises, is that if it gets into the financial market, when I say financial, I mean the banking system. You see, the problem is that when we allowed banks to start playing in the equities market, particularly with options, you expose the banking system to unlimited risk. Now, ideally, we would have these separated. You would have, commercial banks, the type of banks you and I bank with, they have a checking account or whatever, right? And then we had the investment banks that were specifically designed to take on the speculative, risky investments of, underwriting options or whatever, right? But when we allow these two things to become one and the same, the problem is that risk from an investment bank technically could be unlimited. And if you have unlimited risk coming in from the investment bank side, or what I would call the primary dealer side, if that cascades over onto the deposit side, this also has the problem of bringing down the commercial banking network. Now, Josh, as you accurately noted off the air, we saw a version of this in Iceland, in Greece, and in Cyprus when those things failed. And actually in all those, or definitely in Greece and in Iceland, they just froze the system. It didn't matter how much cash you had in the bank. You could only take out 200 euro a day. And like literally people getting on planes, flying to, Germany or whatever, filling up suitcases of cash and flying back, in order to access their cash. But the key thing is that you saw these systems, or you saw these financial institutions on the periphery. Those are going to be the ones to go down first. So, and a modern day example would be Sri Lanka or whatever, right? But here is where it's going to get really ugly. If banks on the edge start failing, then that's going to call into question banks, let's say, on the middle. If banks in the middle are suddenly called into question, this is the contagion spreading through the system. Then banks in the core of, let's say, the Eurozone system, just as an example, might be called into question. So, for example, you might have someone saying, well, okay, well, wait a minute, we're a little worried about, Societe Generale, so don't do any business with them. But we also know HSBC, just for example, does a lot of business with Societe Generale, so now we're really concerned about them. And then, let's say, over here in the States, people might say, well, listen, Citi has a huge book of business with, HSBC. Well, we don't want to do business with Citi. This is the contagion mechanism that creeps in. And essentially, as Jeff Snyder would talk about, the ghost ledger suddenly becomes impaired because banks are no longer willing to trust other banks. They demand collateral to be paid up, or even more collateral to be paid up. But again, this is kind of the opposite side of the liquidity crisis, where there's no liquidity in the there's no collateral in the system in order to pay this back. Or if they were to settle all the books, there's literally not enough collateral to do the settlement. So the system just freezes up and it spasms. Again, this is why I would say that, what's the thing that you can do right now? Well, for God's sakes, have a little cash, like physical cash outside the system, and put it in a safe place, stuff it in your sock drawer or whatever, right? But it's probably very prudent to have that. And not to be like doomsday or whatever, right? But just think about it like this. Imagine if there's like an extended like week-long internet outage or whatever, right? They'll call it a bank holiday. At least that's what they did in the 30s. But just assume that, you won't be able to use your debit card, you won't be able to use your credit card, and it doesn't matter how much you have in a bank. But just make certain you've got a little bit out of the bank, because if the banking system freezes up, those IOUs that you think are your asset, you will discover very, very quickly that you are an unsecured creditor of an occasionally insolvent financial institution, which is, I think, a quip from Rickards on that front. But it's a great quip. So,
yeah, I mean, before you think this is highly unlikely, and I mean, I think it is highly unlikely, it is a possibility. And then, I mean, the next concern would be, well, yes, that would make sense if we were in a free market. But of course, we're not in a free market. The government and the Fed, they would come and bail everything out. But that is one scenario, that they bail everything out, or there could be an alternative motive. Let's say a central bank digital currency that could take the place and free you of all these evil banksters who have been holding your deposits against you as a captive. So there are many different scenarios, which is why we were just explaining what a liquidity crisis could lead to and how a potential way where you could start to prepare. But that is a topic for another discussion. Thanks, guys.
Take care.